and gentlemen, a very warm welcome to you back on Business Today Television. In our effort to navigate volatility that is rising in Indian markets, we bring you the finest brains on Dalal Street, professionals who have navigated the ups and downs of bull and bear markets and made tons of money for their clients. Our guest today is Mr. Rupen Rajguru, Head of Equity Investment and Strategy at Julius Baer India. Good afternoon to you, Mr. Rajguru, and a very warm welcome to you on Business Today Television. How are you seeing sentiment on Dalal Street amidst this global chaos because of tariffs? And at this point of time, how do the Indian markets look to you from the eyes of a foreign institutional investor?
Hey, hi, good afternoon, Shail. Pleasure to be here on your show. Uh, so, it's quite interesting that from a market perspective, there are three things which typically determine the market: uh, sentiment, liquidity, and fundamentals. So, the what happens is that all of us spend at least 95% of the times on the first two factors, which is the sentiment and liquidity. And specifically, as you said, in the current global chaos, if you have Mr. Donald Trump and add to it Mr. Elon Musk also at the helm, and and these people, while brilliant in various ways, but also are their agent of chaos. So there will be a lot of news flows which keep on coming in. So to answer your question, in the current context wherein there is so much of a noise, we have to look through how does it impact India. So if you Indian markets actually were undergoing correction before this tariff tantrum, so to say, if you ask me. And in fact, we have not even touched the previous low. We had touched our previous low was before the tariff tantrum, which was on Nifty at 21,800. So in the current context, uh, India, from all this noise, from a fundamental standpoint and a macro standpoint, is insulated because our exposure towards the US, as far as their exports, and India exporting to US, and our overall trade deficit number, or the trade deficit number they have with us, is very minuscule, hardly 2% of the GDP. So there is no direct impact, but there are indirect impacts because of all the way the global schemes of things are changing. So we were we were going through our own macro headwinds. So we had hit an air pocket as far as our economy and earnings growth were concerned, and hence our market had corrected. Today,
Okay.
as I see, all these factors from an India's macro standpoints are improving. At the same time, the global volatility is there, but what we have seen, the flows and liquidity are improving. So net just to conclude, no, from an Indian standpoint, our macros are on its way of improvement. The earnings, probably we might hit the earnings, low in this quarter four, and earnings will start to look up. And so the fundamental standpoint, it is improving, but the liquidity and sentiments will kind of have its own, I would say, ups and downs. So in the global context, we are definitely better placed than a lot of other countries. And we see any dips which come into the market as a buying opportunity.
Okay. Uh, Mr. Rajguru, how are you positioning your model portfolio in the Indian context? What are you telling your foreign clients in terms of where maximum growth could come in over the next 12 to 18 months, and how are they positioning themselves?
So, Shell, the if you see the hero in this Indian market for last say two quarters or so has been the largest sector, which is the BFSI. So we are dividing the Indian markets. If you look through the spaces in which the valuations are reasonable, and the the growth assumptions are also reasonable. So we are looking into growth at reasonable price. So which all sector fits into that? BFSI fits into that. While BFSI has rallied, but we still believe that the growth is going to be no is going to pick up because RBI is now clearly focusing on growth. And the overall credit cycle has been pretty no okay. So BFSI is one pocket of growth which we see. Secondly, again in BFSI, apart from private sector bank, we also like the life insurance company. So that is again a segment which we believe has reasonable prospects from where we are currently. Then I think consumption is something which clearly has suffered. Specifically, the low ticket consumption. So a lot of the low ticket consumer discretionary plays have been quite ignored by the market, and we believe those will recover because of variety of factors apart from monsoon being good, real inflation or the inflation being lower, and plus effects of the tax relief will come into play. So all that will add into some of these low consumer discretionary items like footwear, apparels, QSR. So that will do well. So these are the segments which we believe, and that also includes hotels and airlines. So that we these are some of the sectors we believe will do well over medium to a longer term perspective.
Okay. Uh, just as we discuss about the broader markets, Mr. Rajguru, we've had record highs on Mazgaon dock. Now, that could be because of the prevailing sentiment between India and Pakistan because of this unfortunate and dastardly attack at Pahalgam. How do you see defense plays in India? Uh, Amongst your model portfolio, does defense have a weightage, and how do you see them progressing from now on?
Shell, I'll probably refrain from talking about individual names, but here, a if you see defense, all the defense stocks had their one major leg up rally sometime last year. So it peaked out sometime, say August, September last year. What were the reasons on why it rallied? Because as you rightly said, in a world in which we are living, especially after the Russia-Ukraine war and the Israel-Palestine issues, the reliance on own defense has gone up significantly, and government has been very focused on that. So the kind of expenditure outlay which government has given for that sector, and hence all the companies associated with that has done well because the order books have soared, and there is definitely, apart from foreign collaboration, there is a clause to have to build a lot of this stuff in house. So a lot of companies have built capabilities. So be it on the shipbuilding side or some of the companies which actually are into making various defense equipments, various products which are used in defense have done really well. So as a structural play, it's a good play. We like it. It will do well, but we have to be mindful of valuations because what happens currently, some of the after the sentiment impact because of the issues which we are currently, or tension which you are witnessing on the between India and Pakistan, sentimentally all the defense stocks have gone up. In fact, sentimentally globally, after the way US has been behaving, no, all the defense stocks across the globe has also done exceedingly well. So currently the sentiment is extremely strong, but I would say after this rally in last 1 month in some of these names, the valuation comfort is no longer there. And we have to also be mindful that how are the how is the government overall balance sheet. So in this year, if you see in budget, government has projected certain revenues which it will get. Some of the projections might be tad optimistic. So what will happen? The payment cycle of government can get elongated. So we have to be mindful that while the order book is good, whether the working capital cycle of all these companies has to be individually tracked. So net, I would say in the current juncture, probably while the outlook is good, but the valuation comfort is not very high amongst a lot of the names which you mentioned.
Fair point. Rupen, how is your team tracking the IT sector. This has been one of the major laggards as far as markets are concerned. The IT index, if you leave the last 10-day rally, has been a point of concern for many equity strategists such as yours. What is your view on software against the backdrop of this tariff war and this very strong emergence of artificial intelligence? Where do you see value in this setup, and where do you see maybe a sunset?
So, Shell, if you know, IT is a pretty interesting sector. It's a very important sector from an Indian standpoint. And this sector has, if you look through, very strong correlation with the Nasdaq index. So typically, the behavior of this index, of IT index in India, will kind of move along the way Nasdaq moves. Uh, and Currently, the after whatever Donald Trump has done, the growing consensus amongst global economists is that the US will either enter into a recession or a significant slowdown. So while the corporate balance sheets in US is good, as well as in fact, US is entering a IT, as they say, the upgrade cycle. So while on one hand there are certain levers which are positives from an IT growth perspective, but if there is a recession, lot of corporates postpone their discretionary spending, and some of the spending which is related to IT on the discretionary side will get impacted. So if you look through the commentary of the top Indian IT companies, it is very, very bleak. For this year, that is for FY26, the growth expectation would be anywhere between 0 to 3%. But here, from a stock market standpoint, what we have historically seen is that a lot of the large IT names, whenever they, it's a mature industry. So whenever it reaches, gets below 20 PE or so on a 1 year forward basis, the payout ratios are pretty good. So they pay dividend plus buybacks all put together. That ratio is close to 80%. So when if you go to below 20 PE and if there's 80% payout, so the dividend yields of some of these companies will start to look pretty good, which is closer to 3 to 4%. So the reason for also the rally in the last 1 2 weeks is because people have also now realized that in an environment, it serves as a defensive play. So while there will be headwinds towards growth, and to add to your point on artificial intelligence, which is, I would say, a known unknown, to what extent AI will, whether it will eat away their business or it will help them get more business, is the verdict is, the jury is not yet out. And some of the IT companies are talking about how they are using AIs, to work jointly to give solutions, to work on IT stacks, to offer it to the client, and ultimately, if the way the digital transformation journey, a lot of these companies got benefited, to have more and more use case of IT at a enterprise level, definitely IT services will be required. So to some extent, they will be getting more business also out of IT, while there will be definitely some bit of impact on their overall business as well. So net, I would say IT, from an AI perspective, its jury is not yet out, but to some extent it will be beneficial to them. And at a bigger picture level, uh, uh, at a valuation that's sub 20 or valuation, it forms a very strong floor for those companies. So that's why we see buying interest coming into that. So probably here, whenever it goes into that 17 18 PE or so, probably we tend to like a lot of these large IT companies.
Okay, fair point. Would you offer a global perspective on how the rupee is shaping up? Is the worst behind us for 2025? We've seen a lot of FII money coming into Indian equities over the last 8 10 sessions, to the tune of somewhere like 38,000 crores. Is the appreciation of the rupee one of the reasons behind it? And where do you see the currency maybe by December 2025?
So here I would say it's more a call on how dollar would be, and to some extent how the yuan also no will behave, or yuan they will want to control, while it's to some extent controlled currency, how it moves. So the that will determine the rupee movement. So if you see this year, the dollar index is, as we speak, it's below 100, and the dollar has depreciated almost 9% vis-a-vis euro, and probably vis-a-vis yuan, it is, more or less even Steven. While with respect to rupee, it has no rupee has done slightly better because it had fallen significantly towards the end of the last year. So, in the current context, if the global order, world order, as they say, is changing, and there is a high possibility that we believe that dollar might be in a depreciating mode for some more time. So, in that context, we definitely feel that rupee is has already found its floor, and rupee might, to some extent, might not appreciate as much as some of the other European countries or Swiss franc, but it will still be much better off than what it has been. So rather than the inherent strength of rupee, I would look into how to what extent dollar is will go down, and that's what will determine the way rupee would be. So probably between now and the end of the year, we might see rupee stable to appreciating from what it is right.
Okay, fair point. And it's heartening to note that a lot of foreign investors such as you are now mildly positive on the rupee, to say the least. Mr. Rajguru, your comment on gold. We've seen a fabulous rally, a 32% year-to-date appreciation in the price of gold. And it's turned many fund managers who professionally manage wealth into a bit of a sorry figure, because gold hasn't figured much in the global investment theme. Now, what ahead as far as gold is concerned? Does your model portfolio have an allocation towards this precious metal? If yes, to what extent?
So no, it's pretty interesting question. And in typically all our portfolios, typically client portfolios, the allocation towards gold, silver is roughly between 5 to 7%. So gold as an asset class probably this year has been one of the best year so far. As you rightly said, it has seen a tremendous rally, and till such time we will have chaos in the world, wherein uncertainty will prevail. We will see gold buying, and I think it started probably after the Russia-Ukraine war, when the Russian dollar assets across the world were frozen. So a lot of the central banks started aggressively buying into gold, to some extent bitcoins and others, and in a way, as classically as they say, it is a hedge against all uncertainty in the world, and also it serves like an insurance premium which you pay for all the chaos, so which has worked out beautifully this year. So while it has rallied, it might take a pause, but till such time this uncertainty will be there, gold will be bid up. As a house, also we probably are. No, we have seen big rally from a price wise. It's more or less done, but still it will be well bid up, and in an environment wherein a lot of people and a lot of money. Typically, what happens after the unfortunately, after the rally, a lot of money also chases that asset. So globally, that might continue for gold, and it might see its rally. But to answer your question, as a hedge, we typically have between 5 to 8% exposure towards precious metals like gold and silver.
Okay. Mr. Rajguru, we've seen a record high on the Nifty Bank, as also on the Fin Nifty. Now, how do you assess probabilities that Nifty will hit a record high in 2025, given that the IT sector seems to have bottomed out, and this was one pain in the proverbial that the Nifty was facing? Your prospects of the Nifty in the remaining 8 months of calendar 2025.
So, Shail, uh, we have seen, if you were to decipher the first quarter, we saw a sharp drawdown in Nifty and a sharp recovery thereafter in April. So we probably are 2 odd percent higher, in the first 4 months of this calendar year. So as I said, that today, we probably earlier in March or so, we had hit a zone at a index level. We were at say 18 times at that point of time on a FY27 basis. Today we are back to around say 19 and a half, 20 times. So from the current juncture, do I see a big upside in Nifty? Do we see Nifty crossing all-time high this year? The probability I would assign would be a slightly lower. Why? Because the earnings momentum is not with us right now. Earnings momentum will start picking up from second quarters of next year. So here, I would say as a range, if I were to give you, beginning of the year, what we had said, probably Nifty will be in the range of say 23,000 on the lower side and say 25 and a half thousand on the higher side. While we breached 23, or we went below 23 also, thanks to the tariff tantrum, so to say. But we are firmly now above that, and we are today, as we speak, it is closer to 24.3 odd levels, uh, and hence from here on, we at an index level probably 5 to 6% upside between now and end of the year is possible. But at the same time, as we began our conversation saying, talking about the global volatility. So if the global volatility comes back, we might again go back to that 23 odd levels or so. So that is the range. And probably on the calendar year 26, once we see the earnings momentum, which is now down to 3-4%. So Nifty earnings growth this year would be closer to 3 to 4%. It will go up to 11 to 12% for FY26, and more of that will be seen in the third and the fourth quarter. So as we get into that, we might see probably sometime middle of next year or so, probably we might see market levels which might be closer to all-time highs.
Okay. My final question to you, Rupen, is on crude oil prices. We seem to be in a really, really fortunate instance as far as India's situation is concerned as an oil importer, that global prices are now consolidating near 4-year lows as far as crude is concerned. How do you see this commodity over the next 1 year or so? And how do you see it impacting India's macro balance sheet?
So, one blessing in disguise for Indians has been, of all these chaos, has been lower crude prices. So ultimately, from a fundamental standpoint, uh, you know, uh, for any commodity, you look into both demand and supply scenario. So while the supply has been there, and US actually is going to be supplying more, as time progresses. So, and if globally if US either gets into a recession or a slowdown, and there is the global growth estimates are lower, so from a demand standpoint, the demand is not going to be very high. So this soft patch in crude might continue from no at least next 2 to 3 quarters perspective, and that clearly is beneficial for us, because for every a dollar of $10 lower of crude price, our deficit amount changes by $10 to $12 billion. So it is beneficial to us in that context. And to add to it, as I said, from a issue from an Indian standpoint, if you ask me, while CAD has been there, but the for last 1.5 year has been the balance of payment issue, because on a net basis, the FDI plus FPI of our flow for India has been negative. So if now with a lower US dollar, thanks to whatever is happening out there, if the flows comes back into India, and add to it lower crude price, which is also benefit for our both the twin deficits. It is good, and if the balance of payment becomes good, so it will definitely is a very good macro scenario for India. And as I said, to add to it, if the earnings story which was broken this year, if that we believe will start to show up from second quarter of next year, so all these are good potent components which will lead us to, as I said, probably to all-time high levels. But for that, we'll have to wait for all these things to pan out, and probably a year and a half from here.
Okay, fair point. And the final question on the model portfolio that Julius Baer has for India. How many stocks are there in that portfolio? How many are large caps? That will, explain your tilt towards the market in the coming 12 to 18 months, Rupen.
So, see, on an average, the stock is between 23 and 25. And at a market capitalization level, around 60 to 65% would be towards large cap, and the 25 to 30% would be towards mid cap, and a lot of these might be largish mid caps, and remaining would be towards small caps. So our bias clearly remains towards large cap, and in the current juncture, we believe the large cap this year has done well, and I think incrementally also, if you see for last few days, the largest market cap company in the country has done well, and probably we are seeing their recovery. So unlike US, in India, the top 10 stocks has not done that well, and we believe the large cap in this current environment will be something which will do well, and our bias and tilt will remain towards large cap or the largest mid cap companies. And if as and when there are opportunities coming through in small caps and all, we look into those companies which there is a non-linear earnings growth because of the way either the promoter, the way they are executing, or they are into some niche business or niche business they are, and that's what we look into. But yes, we are focusing on large cap as of.
Right. With that, Rupen, thank you so much for your time. And here's hoping that the portfolio works really well and that clients of Julius Baer make a lot of money on their India exposure. Thank you so much, and let's hope that we meet soon again and discuss the way forward for Indian markets.
Thank you very much.
That, ladies and gentlemen, was Mr. Rupen Rajguru at Julius Baer India, and this is the basic structure of the model road portfolio that Julius Baer manages in India, mostly large cap focused with an emphasis on private banks, including insurance companies. They had earlier reduced their exposure to software companies, but have added some of them as prices corrected sharply and dividend yields came into focus. Some part of the portfolio is into consumer discretionary stocks, and they remain underweight on the automobile space. Please continue watching Business Today Television. There's a lot that's happening on the other side of that break.
Amid growing tensions after the deadly Pahalgam terror attack,